There are moments in the crypto market that, in hindsight, are called historic, and today might be one of those moments. While you may be scrolling through your feed without realizing what's building beneath the surface, the Intercontinental Exchange, the operator of the New York Stock Exchange, has officially launched new Bitcoin futures based on CoinDesk indices, including a contract specifically focused on Bitcoin itself. This is a regulated vehicle for institutional capital, and it could truly be a game changer. Think of the market like an ocean. You see the waves on the surface, but far below, powerful currents are moving massive ships. Today, that current just received a new lighthouse, ICE Bitcoin futures. These contracts allow large players to gain or hedge Bitcoin exposure without moving a single spot coin. And this is happening at a time when Bitcoin isn't just trading. It's moving through one of the most critical phases we've seen in years. After the historic rally above $126,000 into late 2025, which pushed thousands of traders into euphoria, nearly 97% of the circulating Bitcoin supply moved back into profit, according to Glassnode. But then came the twist. When 97% of coins are in profit, the probability of short-term profit taking rises dramatically. The market becomes fragile. And that's exactly what on-chain data started signaling. Increasing realized profits, growing volatility, and subtle signs that some long-term holders were beginning to distribute into strength. If you've lived through multiple cycles, 2013 or 2017 and 2020, you know this pattern. In 2017, extreme profit concentration led to the final blow-off top. In 2020, institutional money quietly accumulated after the COVID crash, right before the massive breakout. Today, we're standing at a similar inflection point, but this time the market is larger, deeper, and far more regulated. And this is where today's launch becomes critical. While many retail participants are still debating whether Bitcoin is a trading asset or a digital reserve asset, large financial intermediaries have already started playing a game most traders don't even see. Futures tied to regulated indices give them a tool they didn't fully have in previous cycles. The ability to manage risk efficiently and scale positions massively. We're not talking about a few hedge funds experimenting. We're talking about institutional capital that would have been sidelined if only spot markets existed, and now can enter the market without directly custodying Bitcoin. They can go long, short, hedge exposure, run arbitrage strategies, and deploy liquidity that would otherwise stay in traditional markets. And that creates extreme short-term volatility potential. Over the next 12 hours, markets are expected to experience heightened price swings as traders and algorithms try to determine one thing. Is institutional money buying this dip, or are they using these futures to apply controlled short pressure? Imagine holding a beach ball underwater. You can see it pushing upward, but the weight of the water keeps it submerged, until suddenly, it explodes to the surface. That tension between suppression and release is exactly what we're seeing right now. Another critical factor is the role of ETFs. Since their approval in 2024, spot Bitcoin ETFs have absorbed enormous capital, at times several $billion per week, effectively pulling liquidity off the open spot market. That supply absorption contributed heavily to the structural rally we saw into 2025. But in recent weeks, something shifted. We've seen persistent ETF outflows, nearly 10 consecutive days of net selling in both Bitcoin and Ethereum products. That doesn't necessarily signal abandonment. Instead, it points to repositioning, caution, rotation, and institutional risk management during a structural transition. Now you might be asking, if so much capital is involved, why is price pulling back? This is where psychology becomes fascinating. While you might feel panic, uncertainty, or think the market is broken, whales operate differently. They use derivatives to manage exposure, create liquidity events, and influence price trajectories, often without moving large amounts on-chain. Futures markets in the coming hours and days will offer a window into this activity. Spot transactions can be opaque, but futures open interest reveals where positioning is actually building. And here's what's important. Aggregate open interest across Bitcoin perpetual contracts has been climbing steadily. That signals capital entering the derivatives market, not exiting the ecosystem. Now this is where it gets interesting. A surge in open interest combined with the launch of regulated futures on a major exchange like ICE can mean two things. Either it's the early stage of large-scale accumulation preparing for a renewed spot rally, or it's the foundation of coordinated hedging strategies that could engineer directional moves designed to shake out over-leveraged retail traders. The market is playing a game you don't see. Most retail analysis focuses purely on spot charts. But the real battlefield is in index construction, funding rates, option skew, basis spreads, hedging costs, and smart money flow dynamics. And those signals suggest this is not an ordinary pullback. Structural trends remain intact, but they're rotating in ways only experienced players fully understand. Bitcoin recently built strong support in the $70,000 to $75,000 range. That zone is now the test. This is where institutions may accumulate aggressively or strategically unwind. If you're wondering whether the next big move is a breakout to new highs or a final capitulation flush lower, here's the key distinction. Institutional adoption does not automatically mean immediate price appreciation. It creates structure, depth, liquidity, two-sided markets. It allows both long and short expression at scale. Institutions don't think like retail traders. They think in volatility regimes, risk-adjusted return models, and capital efficiency. That's why analysts from firms like Glassnode and Arkham Intelligence emphasize something subtle but powerful. Yes, 97% of coins are in profit, but that very fact increases the probability of short-term pullbacks. Because institutions don't just buy and hold. They hedge. They arbitrage. They manage exposure dynamically. While you might be in panic mode, they're structuring positions. While you're reacting to red candles, they're calculating funding rates. While you're questioning whether the bull market is over, they're asking where liquidity is weakest. And here's the deeper truth. Markets move where pain is maximized. If leverage builds too heavily on one side, the market will often move against it. The introduction of new regulated futures expands that battlefield significantly. So ask yourself this. Do you believe this futures launch is the catalyst for the next major expansion phase? Or is it the setup for one final volatility event designed to reset positioning before continuation? Drop your opinion in the comments, because the real debate isn't happening on the hourly chart. It's happening in how institutional capital is restructuring the crypto market in real time. At the end of this day, February 11th, 2026, you may look back and realize something important. Not every major move begins with fireworks. Sometimes it starts quietly with infrastructure being built beneath the surface. A silent foundation. And when the market finally recognizes what's been constructed, it doesn't just rise. It accelerates. If you found value in this deep dive, hit the like button, subscribe for high-level crypto analysis that goes beyond surface headlines, and stay close, because the next 24 hours could reveal more than most traders are prepared for.